In the last 48 hours, something happened that most people still haven't clocked, because it doesn't flash on a chart the way a crash does. Short sellers have already logged roughly $24 billion in mark-to-market gains year to date, while one corner of the market, software and adjacent mega-cap tech, has lost about $1 trillion in market value. Not months, not weeks. In a compressed span where liquidity thins, spreads widen, and the story people tell themselves always arrives late. They said the post-meme era would be different. They said the market had adapted. They said prime brokers, option market makers, and clearinghouses had strengthened the circuit breakers, so squeezes couldn't run the way they used to. But the data being published right now suggests something else. A short squeeze setup can form quietly, even while the short side is winning, simply because the trade becomes too popular to exit cleanly. Here's the uncomfortable truth. Institutions already know where the stress is concentrated. They see borrow availability. They see locate scarcity. They see which books are leaning in the same direction. They see consolidated short interest snapshots as they update. And while most people are staring at earnings calendars and macro headlines, the pressure is building in the plumbing. How much of a company AES float has been promised to sellers who must eventually buy it back? What I'm about to walk through changes the way this market looks. Not by naming a single ticker as destiny, but by showing the mechanism that turns ordinary volatility into a squeeze and why the ingredients are quietly lining up again. Welcome to Signal Decode, where we translate the numbers before they become headlines. If you're here for calm, data-first analysis of positioning, liquidity, and incentives, consider subscribing the same way you'd keep a wise elder in your circle, quietly and consistently, and drop a comment with where you're watching from, because this market is global now, and flow doesn't respect borders. Now let's get forensic, because this setup isn't built on vibes. It's built on dates, numbers, and the way risk managers behave when trades get crowded. In early February 2026, consolidated short interest files for the first full trading week of the month, covering dates like February 2nd through February 6th, became visible in the public window. On the surface, that sounds routine. In reality, it's one of the few moments you get a standardized snapshot of crowding that isn't filtered through commentary. At the same time, the broader tape has already rewarded bearish bets at scale. When short sellers can point to about $24 billion in gains this early in a year, it signals the trade has worked broadly enough to build confidence, attract additional capital, and encourage bigger sizing. And pressing into weakness is how squeezes get born. One detail from that same period is especially revealing. Short interest was reported as rising in names that were already under pressure. Broadcom's short interest was described as up roughly 15%, and Amazon's up around 10%, even as Broadcom was down about 10% year to date at that moment. Translate that into incentives. A trade that works becomes a magnet. A magnet attracts more participants. More participants increase crowding. And crowding reduces flexibility. When flexibility disappears, the market can turn a small move into a forced move. Meanwhile, outside the mega caps, the crowding gets almost surreal. Some screens show companies with short interest approaching levels that older market regimes would have treated as structurally unstable. Telesat has been listed with short interest near 90.46% of float. AirSculpt has been listed around 82.62% of float. Those aren't normal numbers. Then you have names where the short interest is large enough to matter, but the float is liquid enough to interact with options and momentum. Applied Digital is one clear illustration. As of a January 15th, 2026 reporting point, the short interest is about 86 million shares, roughly 34% of float, up more than 13% from the prior report, with around 1.9 days to cover. That last metric is not a prophecy, but it's a pressure gauge. It tells you how quickly the market would need to absorb buying if the short side had to reduce exposure under stress. So here's the central contradiction. If the short side has been winning, if price is already repriced lower and short books are in profit, why is the short side still adding? Why is crowding increasing in pockets where the downside has already shown up in price? That mismatch is the seed of a squeeze setup, because it means the short trade is relying on continuation, and continuation is the one thing squeezes steal. To understand why, you have to zoom out and see the pattern across decades. Because the playbook that creates squeezes didn't begin with social media, and it won't end with it either. In 1998, during the long-term capital management crisis, the pain wasn't only the direction of rates or spreads, it was the crowding and leverage that made exits impossible. Trades that looked diversified became correlated in the unwind, and the market cleared the imbalance through violent repricing. In 2008, the Volkswagen episode showed how impossible price moves can happen when float is scarce and short exposure is concentrated. The details were unique, but the structure was universal. Limited supply met forced demand, and price became the clearing mechanism for constraints, not for a new fundamental model. In 2011, during the Eurozone stress period, you saw another variation. Risk-off flows created crowded shorts and crowded hedges, and then policy signals triggered abrupt reversals. The lesson wasn't that everything goes up. The lesson was that the most crowded positions move the fastest when the narrative shifts because the exit door is smaller than the position size. In 2020, a new generation watched the same structure play out in a different costume. Volatility spiked, liquidity vanished, and positioning became destiny. Certain names rallied far beyond what a simple model would have implied, not because cash flows changed overnight, but because buy-ins, hedging flows, and short covering synchronized. Now, in 2026, the pattern is forming again in a more distributed way. It may not be one headline ticker. It may be a cluster of crowded shorts across a theme, a factor, or a liquidity tier. But the mathematics are the same. When too many positions share the same exit plan, the exit becomes the risk. Here's what most people miss. A short squeeze is not a story. It is a mechanical event. It is what happens when the market's constraints change faster than crowded positioning can adapt. So who are the players when this setup is building? Start with prime brokers, the intermediaries that make leverage possible. When a hedge fund shorts a stock, it borrows shares, pays a borrow fee, and posts collateral. That collateral is governed by margin models tied to volatility, liquidity, and stress scenarios. If volatility rises, margin requirements rise. If margin requirements rise, leverage capacity shrinks. If leverage capacity shrinks, positions that were comfortable become heavy. This is why squeezes often occur after volatility rises, not before. The system tightens at the worst time. Now layer in the lending side. The shares being borrowed come from lenders, custodians, asset managers, and other holders willing to lend inventory for a fee. Those lenders can change terms. They can raise rates. They can recall shares. They can lend less as inventory tightens. Borrow costs are not just a footnote. Borrow costs are friction, and friction changes behavior. A short position can be right on direction and still become a bad trade if carry costs climb or if borrow becomes scarce. Then there's the options complex. Market makers are not directional investors. They price risk and hedge it. When call demand increases, market makers may need to buy the underlying to stay hedged. That buying is not opinion, it is obligation. If open interest stacks its strikes just above spot, hedging can become reflexive. Price rises, delta increases, hedges require more buying, and the move accelerates. This is why squeezes can feel like they come from nowhere. The demand is embedded in hedging rules. Add to that the systematic players. Trend systems, volatility targeting, and risk parity style exposures respond to price and volatility, not to narratives. If price starts rising and realized volatility changes, some systems add. If the move becomes sharp, other systems de-risk, which can change correlations and liquidity in ways that surprise discretionary traders. A squeeze often becomes larger when different mechanical systems respond in the same direction at the same time. Then come the exchanges and clearinghouses that sit at the center of collateral. They adjust margin, haircuts, and stress tests as volatility regimes shift. Those adjustments can happen quickly, and they ripple outward. Brokers demand more collateral from funds. Funds meet calls by selling what they can. If the short is the position that has become risky under the new model, the unwind occurs through buying, often into thin liquidity. The timing matters, because collateral calls are about deadlines, not about comfort. Finally, there are the reporting systems that publish short interest snapshots. These reports are imperfect and lagged, but they reveal crowding. In early February 2026, when those consolidated files reflect heavy short exposure alongside a market that has already moved sharply, they act like a map of where the exits are narrowest. Now we reach the dislocation, the place where two sets of signals tell opposite stories. On one side, price action in parts of tech and growth looks like a clean repricing. It suggests risk is being reduced. It suggests valuation, compression, and caution. On the other side, short interest is rising in the same ecosystem, suggesting the bearish trade is not just a hedge being expressed and closed, but a bet being increased. That's a critical mismatch, because it means the market has already handed the short side profits, yet the short side has chosen to add exposure rather than reduce it. There's another dislocation that matters even more: the difference between paper liquidity and real liquidity. Paper liquidity is the volume on a screen, the bids and asks that imply you can trade any size. Real liquidity is what remains when volatility spikes, spreads widen, and the true size behind those quotes disappears. Squeezes happen when paper liquidity looks abundant until the moment it's needed most, and then it vanishes. That's why extreme short interest percentages are not just curiosities. If a company shows 90% of float short, it implies a market where the ability to buy back shares depends on holders being willing to sell into strength. But squeezes change holder behavior. Strength can create withholding. That reduces supply at the exact moment demand must rise. And when supply falls while forced demand rises, the market clears through price. Let me show you the evidence with hard numbers, because this is not opinion. This is pattern. First, The magnitude of short seller profits early in the year, $24 billion in mark-to-market gains, is a signal that the short trade has worked well enough to attract capital and confidence. In crowded trades, confidence becomes fuel, and fuel later turns into forced behavior when conditions shift. Second, the sector-level drawdown of roughly $1 trillion in software and adjacent tech market value. That is a massive transfer of expectations. It tends to raise volatility, and rising volatility tightens leverage conditions. Even without any new headline, that alone can change the stability of positions. Third, the specific increases in short interest, even after declines. Roughly 15% more short interest in Broadcom and around 10% more in Amazon during a period of weakness. Those figures do not guarantee a squeeze. They do show that the short side is still pressing, which increases the probability of crowding. Fourth, the extreme concentrations. 90.46% of float in one widely cited case and 82.62% in another. At those levels, the trade becomes sensitive to small changes in supply and demand. The exit door is small by definition. Fifth, the practical mid-tier example where the math becomes immediate. 86 million shares short, 34% of float, up 13% from the prior report with 1.9 days to cover. In calm conditions, that might look manageable. In stressed conditions, it becomes a scramble because covering demand arrives when liquidity is least cooperative. Now, here's where it gets interesting. A profitable short can create a false sense of control. The mark-to-market is green, the thesis feels validated, and risk committees become comfortable. That comfort allows size to grow, but size changes the nature of a position. Once a short becomes large, it stops being a view and becomes a liquidity obligation. There are three underappreciated triggers that turn that obligation into urgency. The first is a borrow recall. The stock is borrowed from a lender, and the lender can demand it back. When that happens, the short must replace the borrow or buy in. That process concentrates demand into short windows, and it can happen quietly without a headline, simply because availability changed. The second is a volatility regime shift. When implied volatility rises, margin models tighten. Prime brokers raise requirements. Leverage capacity shrinks. A position that was stable under one volatility assumption becomes unstable under another. This is why squeezes often ignite right after a period of stress, when the system's risk settings have already been turned up. The third is option-driven reflexivity. If call demand increases and open interest stacks above spot, market makers may be forced to buy the underlying as hedges. That buying pushes price higher, which increases hedge ratios, which forces more buying. It's not a conspiracy, it's arithmetic. And it can happen even when the fundamental news is bland. This is also why days to cover can mislead. 1.9 days to cover sounds manageable if you imagine average volume staying stable and sellers appearing on queue. But squeezes do not happen in average conditions. They happen when volume becomes one-sided, spreads widen, and liquidity providers step back. In those moments, a widely followed stock can trade like a thin, small cap. Covering that could take 2 days, tries to happen in 2 hours, and that time compression is what makes squeezes feel violent. So when you watch for signals, don't just watch price, watch behavior around key levels. Watch whether rallies occur on lighter volume, suggesting holders are not distributing. Watch whether downside momentum slows even as short interest rises, suggesting the marginal seller is getting exhausted. Watch for abrupt changes in option, open interest. It strikes just above spot, because that is where hedging can flip from dampening moves to amplifying them. Watch for intraday reversals that repeat, because repeated reversals often mean forced flows are colliding with natural liquidity. There is also a quieter institutional tell that shows up in how hedges are deployed. When funds want to reduce exposure but can't or won't sell core holdings, they lean on short baskets, sector ETFs, and a handful of single names that behave like proxies. That concentrates short interest into a surprisingly small set of tickers, even while the public narrative talks about broad de-risking. In that structure, the short is not only a view on one company, it is a hedge against an entire theme. That matters because a hedge gets adjusted on schedule and on risk limits, not on patience. If one of those proxy shorts starts rising, funds can be forced to cover quickly to keep the hedge ratio under control, and that buyback can lift other correlated names as the basket is rebalanced. This is where the dislocation between index behavior and single stock behavior becomes important. An index can drift lower in an orderly way, while one heavily shorted component gaps higher because the index has many offsets and the single stock has one constraint, float and borrow. Once covering begins, it changes the tape in a way that recruits new demand. Momentum systems respond. Volatility sellers step away. Call buyers appear because the move looks confirmed. Each layer adds buying at a different time scale, and that staggering can keep a squeeze alive longer than logic expects. In thin conditions, even incremental buying can punch through risk limits, and risk limits are what turn a trade from optional to forced. That's why the earliest warning is often not a headline, but a series of small frictions. Wider spreads, fewer shares to borrow, and rallies that refuse to fade despite skeptical commentary day after day. One more thing matters, and it's subtle. Expert contradiction. In periods like this, public commentary often stays anchored to tidy narratives, valuation, earnings, macro, but positioning can be shouting a different message. When price says risk is being reduced, yet short interest says the bearish trade is getting more crowded, you're looking at two realities at once. The market can live with that contradiction for a while. It cannot live with it forever. Eventually, the constraints win. Now, let's talk about what this means going forward, without pretending anyone can script the next candle. Historically, when these ingredients align, crowding, profit-reinforced confidence, volatility-driven, margin sensitivity, and option-driven reflexivity, the market tends to force a resolution, not because it wants to punish anyone, but because it is a system that clears imbalances through price. In a conservative pathway, the crowded short remains profitable but becomes choppy. Borrow tightens, carry costs rise. Risk desks lean on exposure. Shorts reduce slowly, not because the thesis is dead, but because the trade becomes inefficient. That kind of unwind can still produce sharp rallies, because covering happens in bursts, often at the same time as hedging flows. In a moderate pathway, a catalyst arrives that is modest in fundamentals but meaningful in flow. It could be an earnings surprise, a guidance shift, a policy headline, or a change in rates expectations. The catalyst does not need to be world-changing. It only needs to move price into zones where risk limits activate. Covering accelerates, option hedging adds fuel. Price moves faster than commentary can keep up. And then the story gets written after the move. In an aggressive pathway, the market experiences a liquidity shock in the opposite direction, a sudden bid that forces broad covering at once. This is where squeezes become historic because feedback loops synchronize. Shorts buy back, market makers hedge calls, systematic momentum flips, and the move becomes self-reinforcing until the flow exhausts or constraints change again. If the setup keeps building, the market will eventually choose a clearing mechanism. It might be a slow normalization where shorts reduce quietly as borrow tightens. It might be a sharp repricing sparked by a single report date, an earnings release, or a volatility spike that forces margin calls. Or it might be a rolling sequence of squeezes across multiple crowded names, each one feeding the next as capital rotates. None of that requires faith. It only requires that constraints tighten faster than crowded positions can exit. When that happens, chart moves will look sudden, but pressure was visible all along. Those who understand this are not necessarily smarter. They are simply looking at the right layer. Most people watch price. Institutions watch constraints. Price is the headline. Constraints are the script. The wealth gap in markets is often an information gap. Not secret insider information, but structural information. Where crowding sits, how leverage is financed, how quickly margin can change, and how options can amplify moves. Institutions move first because they see those pressure gauges first. Retail tends to move last because it sees the move after the system has already begun clearing. And that's why this matters now. The setup is building in plain sight. Not as a guaranteed outcome for any one ticker, but as a rising probability of nonlinearity. Moves that are larger and faster than the story would suggest. This is Signal Decode, where we decode what matters before it becomes headlines. If this helped connect dots you hadn't connected yet, you know what to do. And the real question isn't whether crowded positioning eventually meets a clearing event. The question is whether you'll recognize the pressure building before the release.